presentation, which will be the financing part of it. I, like I said, my name is Wale Fasheru. I'm an associate broker with Keller Williams Fairfax Gateway. I've been in this business since 2016 when I retired from my first career as a civil servant with Fairfax County government, working in land development and a little bit of IT. And I bring that experience to you today to be able to help you with your transaction. So before I go further, I want to say congratulations to you for making the first step, for taking the first step on your home ownership journey. Since you are here today, I know you have a lot of questions, and we're here to answer all the questions for you. Because we're in the tax season, I have a message for you today. If you think you're going to get a refund for your tax refund, I will encourage you to think using that tax refund as an investment in buying your first home or buying your first investment property. What are we going to cover today? We are going to cover the fears and facts about buying a home. I'm going to also present to you some of the realities of the market. I'm sure some of you still think we're in the market of 2001 and 2002, but unfortunately, we are actually in another market today. Following that, I will share with you the 10 simple steps of home ownership. Depending on who you talk to, it could be 6, it could be 8, but the book that we're using today, which is the basis of this presentation, is basically, we have 10 simple steps in there, and that's what we're going to try to follow. And subsequently, after that, we'll talk about the next steps, and that's what we will do. So let's get to business and start with the fears and facts about home buying. There is a myth out there that I cannot afford to buy right now. And I tell you that most people don't really know whether they can afford to buy or they cannot afford to buy. What you have to do is you have to sit down and do the math and see whether that is feasible or not. That is the reason why I'm here today. I'll be able to help you through the process. Jeremy Johnson will be able to help you through the financing part of it, because that is the most important thing when you want to buy a home. Do you really have the money to buy the home? Unless you are rich enough to be able to pay cash for buying your home, you have to go through a lender. And that's why Mr. Jeremy Johnson is here today. The second myth is, should I wait till the market gets better? I can tell you that the market swings just like a pendulum. and it goes back and forth, and nobody really knows when the pendulum is going to stop. So what I will encourage you is, if you can afford the mortgage, then you should buy the house. There is there is a new phrase that is going on around now because of what had happened in the interest rate, is that you date the rate and you marry the mortgage. Basically, what that means is that because you can refinance at a later date, you will be able to, you can refinance at a later date. That's why they say, just date the rate and then, marry, committed to buying the house. The fourth, the third myth is that I do not have the down payment to pay for the property. Well, only the veterans in this country have the opportunity of having a zero down payment on their property. Every other person that is not paying cash, you have to pay some money. Whether you get a grant from somewhere, whether your rich uncle or aunt is giving you part of the money, or you have saved some money, you have to have at least a little bit of skin in the game. That is what they always say, that you need to have some skin in the game. And there are so many ways in which you can get your down payment. I just mentioned a few of them. Jeremy will discuss that in details as well. The fourth myth is I cannot afford to buy a home because of my credit. Yeah, everybody either has a good credit or a poor credit, or you don't even have a credit. We are here today to help you through the process. If you don't have a credit, we can help you establish your credit. We can show you ways in which you can establish your credit. If you have a poor credit, we can actually show you how you can repair it, or we can advise you to go and get and use a credit repair person to do the repair for you. But don't let your credit stop you from buying your home. And the more reason why you have to start talking to us before you decide, okay, this is when I want to buy the property. Sometimes I tell people, start talking to your agent maybe about 6 months before, so that we can find out whatever you need. If we need to go and do a repair on your credit, we can help you through the process. Sometimes it takes about 2-3 months to get that right. Sometimes it takes longer than that, but it's something that we can help you do. Number 5 is I can't afford to buy my dream home. Oh, that's an interesting one. Yes, my first home was not what I would consider my dream home, but I bought it. Why? Because I wanted to start investing in myself. Later on in this seminar, I'm going to also tell you that whether you like it or not, as a renter, you are paying somebody else's mortgage. Would you want to pay your own mortgage, or do you want to be paying your landlord's mortgage for you? We will also show you why it is better for you to start paying your own mortgage. Number 6 is I want to wait until I am certain about my domestic future. Meaning, I want to wait till I get married, or sometimes it's like, oh, I want to wait till making X amount of money. Please don't do that. You know, if you can afford to pay the mortgage, if you can afford to pay rent, pay your own mortgage. That is my advice. The other one is that, which is number 7, is that people are saying that home buying seems too complicated. That is why you have me, and that is why you have Jeremy to hold your hands through the process. We've been through it, and we will guide you through the process. So the last one is a lot of people think because they have they have student loan, they cannot buy a house. I'm not your expert in that area, but Jeremy is an expert in that area. He will be able to tell you the impact of student loan when you are trying to buy a property. I'm not really sure there is a lot in there, but because you hold student loan doesn't mean you cannot buy a property. So why buy now? So the next slide, please. So why buy now is you will see that 2021, actually let's start from 2020. Since COVID came, you will see that interest rates really went down and is going back up right now. So historically, within the last couple of years, this is the lowest range of interest rates that have been available. I can tell you that when I came here in 1982, interest rate was almost 18%. So when you are talking about 6% now, I'm just laughing at you. I'm not, it's not really that I want to laugh at you. It's just that, I want you to just understand that, how about those people that were paying, 16, 18%, almost 40 years ago? My first home was like 10%. There is a long-term investment growth when you buy your house. Simply building equity is one of the reasons why you want to buy your own home. And investing in yourself, paying your own mortgage, I will show you later on in the presentation how that works, just to show you how you build equity on your property. When you look at real estate, on an average, real estate appreciates between 3 to 5% every year. The last couple of years have been extraordinary because in this area, we got about 15 to 19%. So if you had bought a house in the last 3 years, you got more than 3 to 5% appreciation on your property, meaning you have to pay more taxes as well. So that's part of the equation. The other thing is also, you have stability in your lifestyle when you own your own home, and you have a sense to the community, and there is the benefit of taxes, and you start building wealth. What I say to people is real estate is an awesome way to start building your wealth. Next slide, please. I put this in here just to buttress what I said a few minutes ago about the interest rate. And this has been the history of mortgage rates on the last, 40 plus years. You will see that in 1980, 81, that was the peak right there. And, we're now in 2013. We're actually 2023. We are actually about 6% now. Yeah, so we're doing better. Next slide, please. Here, I want to let you understand one thing, that over the years, historically, you pay 21% of your mortgage is what you use to pay your mortgage. So if you are making $100,000, you are paying $21,000 for your mortgage. That's on annually. But over the years, and currently we're seeing that it has gone down to like about 15.5%. That is a decrease of almost about 6.4%. More reason why you need to buy your own home. Next slide shows you what is the difference between owning your own home and renting. So in this example, basically we're showing you that if you bought a house for $250,000 and your monthly payment is $1,200, over 30 years, because that's what the terms of the mortgage is, you would have paid $432,000. When you own that home, that money is yours. That is the equity that you have in your house, is yours. When you are renting, you are helping the landlord to pay the mortgage on the house, and that equity belongs to him. If we assume, because the assumption is that, okay, over the 30 years, that is just going to be $1,200, every one of us that have rented a place also know that the rent goes up as well. So if you pay $1,200 for 30 years, you've basically paid $432,000 for your landlord, and you get nothing. Nothing. So the financial benefits of owning a home is, one, you build equity. Number two, there is the appreciation on your property. And number three is the stability. You see right now that basically mortgage rates are fixed. In some cases are fixed, in some cases they are not. But I would encourage you to listen to what Jeremy is going to be talking about the mortgage industry when we get to that point. The next slide, is basically what I've said before. Renters, you are paying a mortgage, just not yours. And I know those of you that have played the Monopoly game knows that in order for you to win the game, you have to buy the properties, and when you buy the property, anybody that lands on your property, you can collect money from them. So I am using this slide to encourage you to buy your own home the next slide is basically, I want to show you what your buying power is. And the reason why I want to show you this is if your monthly payment is 1,800 and you have a down payment of 3.5%, which is the least that you can get apart from the veteran that gets zero, and you're on a 30-year mortgage, this is what happens to you. Let's say your interest rate goes up to is 4%. Your loan value, well, let me go to the purchasing power actually. The purchasing power is 390, just based on that. And these figures are based on if you have good credit, you have good income, and you can qualify. This is basically what I'm just trying to show you what you can qualify for based on your rent. So if you're paying 1,800, you basically qualify for almost 400,000 based on other factors, your credit, your income, and things like that. So because the down payment is 3.5, your loan is basically 377,000. I hope you guys understand what I'm trying to do here. So depending on the interest rate, the higher the interest rate, your buying power goes down. The second example I gave over there is, let's say your monthly rent is 2,000, and you will see there that if the interest rate is 4%, well, let's actually go to 6% because that's what is really current right here. Let's go to 6%. So basically, if you're paying a rent of 2,000, all things being equal, your buying power is 345,000, and your loan value is 333. So I hope that's sinking a little bit. So a lot of people have a lot of reasons why they cannot buy right now. So, and part of it is your job. Jeremy will cover that aspect of it because, you know, there are some requirements that the lenders need for you to meet in order for them to be able to lend you the money. In most cases, they want you to be on the job for 24 months. Now, when I say 24 months, it doesn't mean that you have to be on a particular job for 24 months. But overall, you have an employment history of 24 months. And, you know, Jeremy will clarify that. You know, I don't want to get into the rabbit hole of that aspect of it. The other reason why people hold off from buying is, you know, because of their credit score. I just, you know, kind of covered that a few minutes ago, that, you know, we can help you repair your credit, or we can help you start building your own credit. Sometimes people think that, oh, the house is too expensive. Yeah, in Northern Virginia, yes, the houses are too expensive. But if you're paying a mortgage of $2,000 to your landlord, I can tell you that I can find you a home here that you can still be paying that $2,000 and you are investing in yourself. Now, the home might not be the same because you can rent a townhouse for $2,000. But when you want to buy, you might have to go and buy a condo. But at the end of the day, who owns that property? Yes. So that's the name of the game. That is the name of the game. Also, sometimes, some people find themselves in the situation in which, they have to move, and they're looking at it that, I don't want to stay here for a very short time. Real estate is a long-term investment, So if you are planning on living in the house for 2-3 years, it does not make sense for you, because the cost of acquisition, you might not have recuperated that back. So it is, that is a very solid reason why you want to hold off. So let's get to the next couple of slides, in which I will talk about the realities of the market. And in doing so, I will show you what the average price is in Fairfax, Loudoun County, and Prince William. Here, I want to also briefly talk about when people say we're in a buyer's market or we are in a seller's market. A buyer's market is when the inventory is above 6, meaning that there has to be a supply of 6 months inventory in the market. And that's the reason why we have been in the seller's market for the last couple of years, because the inventory on the market is less than 6. So that is basically the definition of a seller's market. It's less than 6. Right now, we do have, in some cases, less than 2. So in the next slide, I'm going to show you what has been happening in Fairfax County. December of 2021 and 2022 is what we're going to discuss. And for those of you that follow this trend, you will realize that we do not really know what is happening in January right now. It is when we get to February that they go back and do all the analysis that they will provide us the figure. So we do not have January figure right now. So that's why I'm discussing December. And I'm going to compare December of 2021 and 2022. What you will see is that the attached properties, basically an attached property is your condo, if it's a townhouse condo, and a townhouse. And when you look at it, 2021 is 468,000, 2022 496,000. That is a 5.8% increase. That is an average. And I just told you that, earlier on in 2022, the appreciation was almost like over 9%. But they have to do an average, and which means, we have to compare those houses that are $1 million and above to those houses that are like 200,000-300,000. So that's why you have an average there of 5.8%. For detached properties, those are single-family houses. You see that December 2021, we have 960, almost 964, and over $1 million and 41,000 in last year. That is an increase of 8%. Subsequently, let's look at the volume. The volume for attached units sold December of 21 is almost about 10,000, and you will see that December of 22 is less than 7,500. That is a decrease of 22%. That is showing you the lack of inventory. And if you understand supply and demand game, that is what has happened. So because supply was low, the price went up. So I mean, subsequently, the same thing for detached property. You know, you went from 9,417 to 7,047, roughly 25% as well. Loudoun County, that's where we are right here. And you will see that the change for attached property is 10.3%. And for detached property is 11.8%. And you will also see a similarity in the units sold as well, you know, almost about 30% because of lack of supply. Prince William County, it's everything is similar. You know, we're all neighboring counties, so I'm not going to, go over this one. But if you want a copy of the information, I can provide it to you. If you can put your information in the chat, I will be able to either email it to you or something like that. So the next chart is, the next slide is, we're going to talk about the 10 easy steps of home ownership. The first thing is you decide that you want to buy a home. The second thing is you find an agent like myself, and I will help you through the process by leading you to the lender if you haven't got one, which is step 3, to secure your financing. Number 4 is we identify your criteria. When I say that, I mean you have to nail that down. You can't tell me I want a 3-bedroom today and tomorrow you want a 2-bedroom. I want a 2-car garage and now I want a 1-car garage. You have to make up your mind, what kind of a property are you looking for? And it also has to match your lifestyle. So we go over that during the buyer consultation. I'll go over that with you. But when we get to that point, what you are looking at as the buyer is going to be different from what I'm looking for as your agent. I'm looking as your agent, trying to make sure that what we discussed earlier on, to meet your lifestyle is what we are going to be purchasing. And I want to make sure that the property is not a lemon. What I mean by that is that with the inspection process, we would have gone through everything in the property to see if there are potential problems. Then number 5 is we find a home. Once we find a home, the first thing I normally do is I send a copy of the home to the lender. And he is going to now give us a little bit of a fee sheet that will say, okay, I know we've talked about this during securing your financing. This is how much you qualify for, but this particular house that you want to buy, this is the breakdown of your fees. And 9 out of 10 times when we get to closing, they are very, very close. Actually, they have to be. If there is a significant change, then we have to go back to the drawing board. So after you agree that, okay, this is the property I would like, and I want to make an offer, we'll discuss it, and I'll help you craft an offer that meets your needs. Not necessarily your wants, but your needs. And when I say your needs, is that what matches with your lifestyle. Number 7 is we do what they call a due diligence. That due diligence is basically we do the home inspection. We make sure that the house meets all the minimum safety requirements that the laws says they need to have. Then number 8 is we go to closing. You move in and you protect your own investment, and you become the homeowner, and you enjoy the life of being a homeowner. And basically, I will continue to be of service to you. Anytime you have any questions, please give me a call. On this slide, I'm going to also share with you that I have an app that you can actually link yourself in on your phone. Does anybody have their phone here today? So if you have your phone, what I want you to do is, go in and type in app.walefasheru.com, and that will link you to my app. What that does for you is that it gives you access to all the properties on the MLS, which is the multiple listing service that real estate agents have. It is up to date, and when you look at any property, it will show me that you've looked at it, and if you have any questions, you can put, you can ask your questions in there, and I will be able to get back to you. What this does for you is it helps you keep a tab of the homes you are looking at, and in the process, you can also see mortgage information about the property. Sometimes you can also go and see the neighborhood information about the property. This is just to help both of us to be able to get required information about the property. So let's move on to the next 2 slides, to step 1, because I've already discussed that one. I don't know why I forgot to take that home. So home ownership lays the foundation for a life of financial security and personal choice. And here you have already decided you want to buy a home. So let's me try to let you understand how you build equity on your property. So at closing, your down payment is basically the equity you have on the property. So let's say it's 3.5%. So you have an equity of 3.5% on the property. Now, a lot of people get this confused. The closing cost is different from the down payment. Your closing cost is, Jeremy will discuss that. Your down payment is basically what the equity that you have in your property when you buy the property. Basically, if you have a 3.5%, that's what your initial equity. 25 years later, you have almost paid off half the cost of the home. And in 30 years, you have full equity of the property. So that is how you determine the equity you have in your property. This next slide is basically an animated slide that shows you what happened with the property. So the first slide, the first part of it shows when you close the property. So you have equity, which is basically your down payment, and then moving to the right, subsequently, you will continue to build equity on your property up till the end when you have 100% equity on your property. Now, the next slide, I want to briefly just tell you a little bit about the real estate market and what they call the historical real estate cycle. The reason why I'm sharing this with you is because I want you to understand that depending on when you sell your house, you do not really lose money in real estate. So when you look at it, there is a boom for between 10 to 15 years. And that is what the standard is. Historically, that's what has happened. 2 to 5 years, there is what you call a bust. And, everybody is saying, when is the bubble going to burst? And we don't know it. It would have happened before we know it. So, and it takes about 2 to 5 years for that to happen. Now, I want you to pay attention to the floor price. When the bust is completed and we start another boom, you will see that the floor price is right there, and the next floor price, when you have a bust, the peak of the last bust is always higher than the last bust. So basically, the floor the floor price on the first one is the first dashed line. The second one is the third one. But when you look at the middle one, you will see that the peak of the first bust of the first boom is below. Is below the floor price of the other one. So that I want you to really study this, because it's like this really helps you to understand that in real estate, the chances of you losing money is very, very slim. It also depends on when you pull your money out, when you sell the property. If you sell in between the bust, you might lose money, but not that much. And what I have been told is basically, at the end of the day, you do not, the price that you bought the property, even if you sold the house for the price that you bought the property, you still made money. Does that make sense to anybody? Okay. So let's go to the next slide. And that one is, finding your agent. And this is where I want you guys to pay attention. And that's why you guys are going to hire me to be your agent. Really, I love what I do because I'm able to share my knowledge with people. Those of you that know me know that I'm very, very passionate about real estate. And, my passion is not about the big deals. My passion is about the personal touch that I have with my client. I'm happy when my client is happy. When I help my client from paying rent for 12 years to become a homeowner, I'm very, very happy. So what I normally do is, I will educate you about the market. I will do what I call a needs and wants analysis that we do during the consultation, and basically that is where we narrow down what you want in your property. I will also steer you to the homes that meet your criteria. Basically, what I mean by that is that when you tell me you want a 2-car garage, that is where I'm going to take you to. And if you tell me I don't want this neighborhood, I'm not going to take you to that neighborhood. I mean, there is something that they call steering in real estate. And basically, we are not allowed to steer our client in one direction or the other. We are supposed to be guiding them to meet their needs and wants. Now, sometimes when I have more information than you do about what you're trying to do, I will tell you. But at the end of the day, you are my client and you make the decision. So, but my job is to guide you to make the best decision. I would work with other professionals to go through the process. You will see during this process that there are about 4 or 5 professionals that we have to deal with in this process. Jeremy is here because he's the most important person. All the other people are not here because we can manage all that. If you don't have money, you can't do anything. You can't buy real estate, So that's why he's here. So lastly, I would negotiate on your behalf, and we will resolve all the problems that arise during the process. So how do I do that? The only way I can do that for you is if we have what they call a buyer representation agreement. You, as a real estate agent, you are supposed to have an agreement with your client before you go and show them a property. There are some risks involved in the business. That's one of the risks involved. Because if I take you to a property, and, you do not have an agreement with me, if anything happens, who is liable? I want to protect you and I want to protect myself, and that's why I ask you to sign what they call a loyalty agreement. Normally, those agreements are to last for a short period of time. We also understand that a lot of people do not want to commit themselves until they like us, they trust us, and they know exact that we know what we're talking about. So as real estate agents, we have become flexible with that by the introduction of a 1 day agreement. So I'm taking you out, we can have a 1 day agreement. And if you don't like me and everything like that, it's over. And the way I do my business actually is, whether I've been working with you for 2 months or 1 day and you don't like what I'm doing, that's fine. Just realize one thing: I don't get paid until closing. So when do you hire me as your agent? The next slide will show you how I get into that. Basically, there are a couple of ways we can look at that. If you are renting, we want to look at, and I want you to go to the bottom of the, and I believe I have this slide, this page in your handout. And basically, I want you to go to when your last lease payment is. So in this particular example, we're going to look at, okay, my lease expires June 1st. So, which means that June 1st is when I'm going to pay my last payment for the rent. And I'm going to be moving out at the end of June. Now, this also applies to if you are buying your second home or you're buying your dream home. So it's like you want to know, okay, when do I really want to move? When do I really want to pay my last mortgage? So basically, at the end of June, somewhere in June is when we want to take ownership of the property. We want to make sure that we are under contract between April and May. Basically, transaction takes about 30 to 45 days. But Jeremy has done this for me 2 weeks before. So depending on, your situation, they can do that as well. And, in this particular example, we start looking at the property in March. February is when you get your pre-approval, which means in February is when you go and talk to Jeremy, and we start putting all your financings together in January, and you start working with me in January. So we're in January right now. So if you're thinking of buying a home this year, we need to start working together today. We can cut all that down a little bit because we can quickly move to pre-approval. And that pre-approval takes only 24 hours. Yeah, it takes about 24 hours once you fill in when you submit your application. And what I normally do is I do what I call a lender's consultation. At that lender's consultation, I let you, the three of us, your family, the lender and myself, we meet and we go over your finances and everything like that. That gives you an idea of, okay, what I can do and, how soon I can get things done. So that is how you that is how you determine when you hire me as your agent. I believe on the next slide, I am sharing with you who are the other team members in the transaction. Next slide, please. So I, as your agent, not that one. Back. Yes, yeah. So, basically your agent, your seller's agent, your lender. Right here we have Jeremy Johnson as your lender here. The appraiser of the property, the lender actually controls who appraises the property. And they are the one that would actually, tell us who the appraiser is going to be, because they are the one supplying the money, and that they have control over that. The inspection of the property, I have a couple of inspectors that I've worked with over the years, so I will recommend one or two to you, and we'll do our due diligence with the inspection. In case we have some work to do in the property, we can recommend a contractor to you. Closing coordinator, normally if you are a single agent like myself, and that's why I love what I do, because I have, 100% communication with my clients. I don't just, give you to somebody else to start communicating with you after we found the house. I will be the one you'll be talking to all through the process. And then the escrow officer is the settlement agent that basically they will be the one to put the deal together, the legal documents, how much you're going to bring to closing and all those sort of things. That's what we do. So the next slide is basically a short video of what we've just discussed about when you hire your agent. And after that, I will give you an opportunity to ask questions about what we've discussed so far. And
when should you hire your agent? Say your lease is up in April. You would need to move out by April 30th, making your last lease payment on April 1st. This means you'll want to move into your new home no later than the end of April. To make this happen, you'll need to close or take ownership of your new home sometime in April, assuming a 45-day close, be under contract to purchase in late February or early March, begin looking at houses in January, get pre-approved for your mortgage with a lender so you know how much you can afford in December, prepare your finances in November, and begin working with me within that same month. From hiring me as your agent to getting the keys to your new home can take 5 to 6 months. So who's ready to get started today?
Yes, that leads to the question, who's ready to start working with me today? That concludes the first part of the presentation. We've covered the first two steps. At this point, I would like to know if anybody has any questions. And if we don't have any questions, then we can basically go to the next step. But I do have Um, the book that I'm using to do this presentation is called Your First Home. And that book was written by Gary Keller, who is the founder, who's one of the founders of Keller Williams Realty. And I would give you guys a ticket in a few minutes, and we will do a raffle, and maybe somebody can be lucky here to get a copy of the book. And so, who has a question?
I do. You mentioned that the down payment is not the closing fee. So I want to know, like, when do we give the down payment and when do we give the closing fee?
Great question. And, I'm sorry that I kind of messed that up. Normally, what happens is when you put in an offer to buy a property, you have to have your NS money deposit, and that is also included in this presentation, but later on. With that NS money deposit, that actually kind of holds the property for you until closing. So the closing costs are the fees that is charged by the lenders and the settlement agent. All that money plus your down payment is paid at closing. But the NS money deposit is now deducted from that. So let's say your closing costs, down payment, and everything is like about 10,000, and you've already put in, 5,000 as your NS money deposit. So when you make an offer, you have to put in that 5,000. And then at closing, you bring the balance of the 5,000. Does that answer your question? Thank you. Any other question? If there's none, let's just take 5 minutes just to stretch, and then we have Jeremy get ready for the next session, and I will I'll give you the tickets to see who wins the book that I have for you. Thank you very much.
Wasn't on. Can you hear me now? Nice. All right, let's get started. So we don't have to spend all of our wonderful sunny Saturday in here talking to or listening to Wally and myself. Who's been here before? A lot of you guys look familiar. So who's been here before and listened? Yes. 1, 2, 3. Okay. All right. Welcome. Just a little bit about me. Usually I'm dressed up, by the way, and I look just as handsome as Wally. Not today, though, because I've got to go from here to another event, so I'm dressed down a little bit less than normal. But yeah, so just so you know why. Usually I dress up a little bit nicer. But I am a VP slash senior loan officer for Atlantic Coast Mortgage, and I've been in the mortgage business for about 22 years. Okay, so I've got a lot of experience through different cycles, working with a lot of different clients. Most of my clients are this year, they're about 45%, they're saying about 45% of the home buyers in the market today or this year in 2023 are going to be first-time home buyers. Okay, so that means that we're starting to even out. The last couple of years have been, like Wally was saying earlier, major seller's market, right? Unless you had $50,000 to $100,000 extra and a lot of money to put down, it was hard to compete, right? Now we're starting to see a little bit of a shift, even though there's a lack of inventory, like Wally was saying. We are starting to see a little bit light at the end of the tunnel, as they say, for first-time homebuyers. Okay, a lot of the programs that we used to not be able to do very much because it wasn't very competitive, VHDA. That I'll just be really basic here, but there are loans through the state of Virginia where you can put as little to 3%, no money down. We have some special grant money that we have this year for first-time responders, teachers, nurses, people like that. We can get up to $12,500 for first-time homebuyers, and then $15,000 for those first-time responders or teachers, nurses, things like that. So there's a lot of programs. So again, this is just to whet your appetite today, but I wanted to kind of just give you an overview of where the market's going a little bit and to have faith that, hey, look, if you're wanting to buy for the first time, this year might be the year, okay, to not pay that landlord's mortgage. Yeah, I don't need to touch this, right? It'll automatically change, or our wonderful people in the back will change the slides. So first of all, step 3 is about securing your mortgage. And so let's just kind of go in a little bit about the mortgage process. And Wally talked about this a little bit, so there'll be a little bit of redundancy. And if you guys have questions, please just raise your hand. If online you guys have questions, obviously you guys can put it in the chat. But the process is very simple. Behind the curtain, as they say, there is the pre-approval process. You have the documentation process. You find a home, then you have you make an offer, and then that loan gets processed. That's a little more complicated than what you guys are going to see. Basically, what you guys are going to do is make application, okay? That's just give me your data, your name, your date of birth, where you live, where you work, social, all of that good stuff, okay? We call it the 3 C's in lending. We want to find out whether you qualify, and it's based on 3 C's. First and foremost, which Wally referenced, is credit, right? You got to have a decent credit score to be able to buy, all right? And why is that? Because the only way that a lender can see your willingness or lack of willingness to repay your debts is what? Looking at your credit score, looking at your history, okay? Does that mean you have to be perfect? No. We all have a story, right? We all have a story. So it's looking at that credit, and if you're not there yet, Wally and I have done this a lot with clients, is kind of get you on track and kind of, you know, get you to where you need to be so that you can buy and get that credit score up, okay? So the pre-approval process, when you guys do your application, okay, you're going to do that online. We're going to look at, like I said, credit. The next C is capacity. What do you think that is? Your income. Your income. How much do you make, right? We got to make sure that you qualify. In our industry, we use this thing called a debt-to-income ratio. We're going to look at your debt versus your income, and as long as you qualify and up to about no higher than 50%, that means we, as a lender, statistically think that you're going to not default on that loan, okay? That you're not overextending yourself. We're not going to let you spend 100% of your gross or your net income on a mortgage payment. That'd be dumb, right? So we have things in place to help with that pre-approval process. So credit, capacity, and the last thing, which Wally referenced, is cash. What kind of cash do you have for down payment, okay? And we can do programs with little as 0 down or as much as cash, which then it wouldn't involve me, right? Then you pay cash. But Wally would be happy to help you if you paid cash. Right, Wally? That would take the lender out of the picture. No, all this origination process we're talking about here, you don't have to worry about it, okay? So the cool thing about how things have changed in the industry since I got in, everything is now online, okay? When you do your application online, it's very simple. It takes about 10 to 15 minutes, and then you can upload all of your documents, your bank statements, your pay stubs, your W-2s, do it all online. So as Wally was saying, we can actually have a pre-approval within 24 hours. And when I say pre-approval, a lot of people throw around the words pre-qualification and pre-approval a little differently, right? Pre-qualification is basically you and I sitting across the table together and saying, okay, how much do you make? Good credit? All right, you're probably looking at something like $400,000. That's a pre-qualification, okay? A pre-approval, on the other hand, is going to be somebody that's actually made application and we verified credit, income, cash, all that good stuff, okay? So the process for you guys, even though these slides kind of go into a little more depth, it's really easy because my team, my processor, my production manager, my underwriter, the appraiser, all of that's done behind the scenes. All you guys do your application, make sure you're qualified. We'll have that initial consultation to talk about what's comfortable. Typically what I do is I find out what your ceiling is, what the highest you can go, and then we're going to back into a sales price based on your ideal payment. All right? Because just because you qualify for $1 million doesn't necessarily mean you want to pay $1 million, right? Okay, or you qualify for 300. Well, does that mean it's a townhouse or does that mean it's a condo? So we got to talk about that because condos have really high condo fees, right? So when you're buying a townhouse versus a condo, we're going to go through that together as well. So that initial consultation will be part of this process, but basically know that your job, do the application, make sure we're qualified, get us the documentation we need to help you qualify, and then that's it. And then our team jumps in and does all of this, what they call origination, okay? We're the originator. I'm the originator as a salesperson. I'm the one that originates, gets that loan in, right? And then my team does the rest, and they kind of walk you through that, okay? All right, so let's skip those next slides all the way up until common loan types and programs, if you don't mind. There you go, next slide. So there's different types of programs, and we kind of talked about it a little bit, and Wally referenced it a little bit. There are fixed rate loans, and then there's ARMs. Anybody know what ARM stands for? Adjustable rate mortgage, right? Okay, I will tell you, based on where the market's at right now, adjustable rate mortgages are not much better than a 30-year fixed. Okay? But, as Wally was saying, marry the house, date the rate. Rates are going to adjust. Nobody's going to have their loan for 30 years. I promise you. I've been doing this a long time, and people have bought multiple homes and refinanced multiple times in just the 22 years I've been in this business. Okay? So you have a 30-year fixed rate. You come in and say, hey, rates are at 6%, 6.5%. They used to be 3. I want to wait. Well, we can't wait. Well, you could wait, technically. But to wait for 3%, you might be waiting a long time. Okay? Because what took us, what happened to get us to the 2s and 3s? COVID. Does anybody want COVID again? No. Okay? So my point with that is that a 5.5, 6.5 rate in that range is actually normal. Okay? At least in the last 20 years. Now, Wally goes back a little further than I do, with the 18% and things like that. And people always say, well, houses were cheaper back then. True. But incomes were also a lot less back then. Okay? So it's all relative, right? So what I'm saying is now is a good time to buy and not pay your landlord's mortgage. Start building equity. But it is a long-term proposition. You know, if you're, like Wally was saying, if you're going to be moving in 2 to 3 years, you're military, you're coming in, you have orders here, and then you're going to be moving, probably not a good idea because you won't recuperate those costs, those acquisition costs, right? You got to pay a realtor to sell the house. You've got your down payment. You know, depending on where the market goes, it's probably not a good idea. But if you're going to be in this area for a long time, definitely don't be paying your landlord's mortgage, okay? You're going to have to pay to live anyway, right? Everybody has to live somewhere, right? Knock on wood, everybody has a place to live. But if not, you know, it's important to pay your own versus somebody else's mortgage. So adjustable rates versus fixed. We won't go into how ARMs are adjusted and things like that, but just know that there are short-term rates and then there's long-term, but long-term is definitely, today at least, for our conversation, the better way to go because the rates are about the same and it gives you a little more security, okay? Common loan programs, we won't go into construction loans, but we do have construction loans if you want to buy a lot and then you want to build your own home, we can do that as well. FHA, so there are different types of government loans. One is FHA. Anybody name another one that are government loans? Non-conventional, VA, right? And there's another one that's not very common, at least not in the 3 counties in this area. People always get confused, like why is it, what is it? USDA, right? USDA, what's the down payment on USDA? 0. No money down. Okay, people always say USDA, isn't that like a type of beef or something? It's in our world, it's a mortgage for somebody that's buying a house that's more in a rural area. So when I said Fairfax, Loudoun, Prince William, not likely to get a USDA loan, okay? But if you're going out to Front Royal or Winchester or Stafford or Fredericksburg, houses are cheaper, and a lot of them will qualify for USDA, which is no money down. So that's another government loan, okay? The further you go from the city, the cheaper it's going to be, all right? I was just looking at a person that I was helping, but they're looking in Atlanta, and I was looking at Atlanta prices. Holy moly, they're just as bad as here. In some areas, worse, right? So if you want more of a house, Wally can help you as long as you don't go too far. I don't know if Wally wants to drive that far. Maybe. But the further out you go, the cheaper it is, okay? And USDA will allow you to do that. VA is for veterans only, okay? Any veterans in here? Thank you for your service. Are you still in? Very good. Which branch? Okay, very cool. So, yes, so at some point, you know, as a veteran, it's 100% financing. In the last couple of years, unfortunately, VA has taken a hit because you didn't have some skin in the game, as Wally said, right? So a lot of veterans didn't get to take advantage of that benefit. But now the market's changing a little bit, shifting, and we're starting to see a lot more VA loans, okay, which is great because it's no money down as well. Jumbo loan programs. Again, we won't go into the weeds here, but a jumbo program means anything over, in 2023 anyway, anybody buying or having a loan amount over $1,089,000. Okay, so most people buying their first house probably are not going to be buying $1 million house, right? So that's for sake of just terms. Jumbo loan just means anything over that. So for our purposes, we're still dealing with conforming loans. So you have government loans, which is again USDA, VA, FHA, all that. Anything other than government is going to be your conventional loans, standard loans, okay, through Fannie and Freddie, and then that would be as little as no money down, depending on what program we do, and then as much as cash, if you have cash. Yes, sir.
So in some of these
They do. Very good question. Yes. So again, for sake of time in this class, there are caps on the USDA. It's by county. Okay. VHDA, the Virginia program, same thing. There are caps based on the county. So, and I say caps, I mean income. You can't make over a certain amount of income. I had somebody the other day that was a first-time home buyer. Well, we have a lot of first-time home buyer programs, but they said they made 100, and I think he made 130, and his wife made 80, and so that's like over 200 grand between the two of them. Unfortunately, that's not going to qualify for any first-time home buyer program. So that's why this whole process of getting pre-qualified and then getting pre-approved and verifying all that information and then having that sit-down consultation with us is kind of really digging into, you know, what it is you qualify for, and depending on where you're looking. Does that answer your question?
Yeah, so it's on both the income, and then when you were to take one and sell the home, however many years later,
Mm-hmm.
and they'd also cap me then as well.
No. So if you've lived there 2 of the last 5, right, as your primary residence, you can get up to 2. If it's a married couple, you can get up to $250,000 a piece without paying anything in capital gains to the government. Okay. Yep, you got it. That's exactly right. That's a wonderful thing, especially people that have lived in their houses for years, to have that, be able to take that cash. Now, if you have a house and you haven't lived in it for a while, like say for example you stay in it for 2 years and then you rent it out for 10 years, that's different, right? Because you haven't lived in it 2 of the last 5. Then you're going to start to deal with what they call a 1031 exchange, and then do you want to pay capital gains on it, or do you want to roll it to another house? So you can kick that can down the road and not pay taxes immediately. You can still take those proceeds, roll it into another property of like kind, and that's called a 1031 exchange. So you don't have to pay the taxes immediately, just keep rolling it to another house. That's what a lot of people do over time, but we're going beyond the class. But does that make, okay. So why a pre-approval is the great first step. That's the next, I can't see which one that, oh, that's next slide there. Or do we have a question? Uh-huh, yes ma'am.
Please break down what we just talked about, the rollover. It's more technical. Can you bring it to each one level, please?
Okay. You talking about the 1031 exchange? Okay. It's very uncommon, let's just put it that way, because not very many people do this. Most people, when they buy a property like a condo, when they're first starting out, they want to get into the market, right? They're not making a lot of money, but they know they want to invest and they want to pay their own mortgage instead of somebody else's. So they buy a condo or a townhouse, okay? Over time, say like their family grows, they get married, they need more space, so they buy a single family house, right? So for a lot of people, the normal thing to do is to just keep that condo or sell that condo and take the proceeds and roll it into the next house, right? But those people that want to keep it, that don't need necessarily the cash from the equity in that house for the next house, keep it and rent it out, okay? So over time, though, I mean, this is a lot of time, they may decide that they want to sell that condo. Well, they can do that, right? The problem is when you do sell that condo and you haven't lived in it for a while, you're going to have to pay capital gains, long-term capital gains to the government, all right? So one way around that is a lot of people will go buy an investment property, vacation homes, and call it vacation, but call it investment. But they use the equity or the proceeds from the sale of that investment property to roll it into another house, so they don't have to pay capital gains. Okay? At some point, you're going to pay capital gains. And I don't want to get into I always tell people, talk to your CPA, talk to your financial planner, because there's rules and trusts and there's lots of things around that to how to avoid paying taxes. We all have to pay them at the end of the day, right? What's the 2 things unavoidable in life? Death and taxes, right? But I will tell you, coming from a family, my dad's in real estate, commercial real estate down in Houston, but he does the same thing. He just, every time he sells a house, he rolls it into another house so that he doesn't have to pay taxes. But at some point, you're going to pay taxes. Okay, it's just one way of not having to do it immediately, as long as you're continuing to acquire real estate. Does that answer your question? Okay, yeah. If you have other questions, we can go into that. So why a pre-approval is yes, ma'am. Veronica.
Did you say that first-time home buying now depends on income?
No, certain first-time homebuyer programs
Oh, just the
are based on
program.
income. Yes, like USDA, VHDA.
Okay, good.
Those are income-based.
Okay.
FHA and VA are not. You can buy the change with VA is crazy. I mean, I have one closing, or we're supposed to close yesterday, but there was an issue with home walkthrough. They're buying a place at 1.2 million. Guess how much they put down? Zero. Can you imagine a veteran buying a house at 1.2 with no money down? It's high. It's like $9,000. It's high. It's high. But these guys, this is an older couple. So, but I just, in America, right? 1.2 million, not putting any money down. So there used to be limits for VA, but not anymore. But as far as income, only certain first-time home buyers or programs require a limit on income. Yes, sir. Yeah. No income limit. Yep. I will tell you that the reason why most people do FHA is not necessarily because of the low down payment, which is 3.5. That's the down payment typically on an FHA. It's because the credit score is not as good for conventional. Conventional loan programs, you want to have ideally at least a 680. If you're buying and you're putting a larger amount down, 700 is ideal. But if you're a first-time home buyer and you're going through a couple of these like programs that we have, again, I'm trying not to get too deep here, but there's a couple of programs that allow us to do 3% down. And if you have a 680 and you're a first-time home buyer, sometimes that lower credit score doesn't hit you as bad. Okay, but FHA is a very good product. I will say I used to do at least 3 or 4 of them a month, and then the last 2 years I did maybe one the whole year because of the it's just not as competitive. And realtors will tell you that if they see an FHA loan or contract versus a conventional contract, who wins, Wally? Conventional. Why? Because, and it's just perception, but when people see an FHA loan, they think, no, they don't have any money and they don't have good credit, right? Whereas conventional, usually more money down, better credit scores, okay? So, but don't let that deter you, because if FHA is a great program and it's the right program for you, we'll do whatever we got to do, right? It's not to say that you won't get accepted, and more so now it's better than what it was the last 2 years. But FHA is a great loan program. Yolanzo, yes. I think that Wally said that like, what, 15 times? That's the theme of today. Don't pay your landlord's mortgage, right? Because you're going to live somewhere, so might as well pay your own. Yes.
I just want to clarify. So with the VA loan, is there no longer like a cap on your loan amount?
No.
Okay.
No, the only cap's going to be if you already own a home in another state using your VA, based on the eligibility that's been charged, you'll have to pay a down payment on the new one. But there's no limit on sales price. Yep. Okay, so why a pre-approval is a great first step. We've talked about this a little bit before, but it's the next slide, I think. Yes. So we talked about the difference between a pre-qualification and pre-approval. Okay, pre-approval, you got to get pre-approved. You have to have a letter to go with a contract. You're not going to have a realtor submit an offer to the other side. Technically, you don't have to have one, but what seller and what listing agent is going to accept an offer without somebody that's been approved? And when I say approved, that means we've verified everything, right? Okay, they've been qualified and they've sent everything in, right? Because like it says here, position yourself as a more powerful buyer. You've been approved. Lender's been approved. Now, there's 2 types of approval in our world. There's the automated underwriting, and then there's the manual underwriting. When I do it and get that pre-approval together, I'm going to run it through this automated decision engine, we call it. It's called DU, Desktop Underwriter. It will take your information, your credit, your income, and all that stuff, and spit out an approval. That's the underwriting approval. That's what they call Desktop Underwriter. That's what I issue my pre-approval letter on. But once you submit your loan in, once you have a ratified contract with the seller, then we send it in and do the manual underwriting, okay? So you want to put yourself in a good position by having a pre-approval. You improve your negotiating power, obviously, with a full approval. Enjoy an easier and shorter closing period. I will tell you that most banks are going to take 30 to 45 days to close, okay? In my world, because we're local and all my staff is local, Veronica, how long did we take to do yours? Was it a month, typical month? Okay, so we can close if we need to. We can close in about 2 weeks, okay? Because we have our own panel of appraisers. We have our own people. Now, the only thing that's going to take a little longer is if it's a VA loan, because we have to go through VA to do the appraisal process, which they require at least 2 weeks. So VA is probably about 3. But every other loan program, if you guys work with me, we can close quickly to be competitive, even if it's an FHA loan, okay? And obviously when you're approved, you reduce unwanted surprises. I will tell you, I've been pulled into many cases where a bank or an online lender or somebody did a pre-qualification, said they were qualified, and basically said, let's throw it up against the wall and see if it sticks, right? Well, in my world, I work 99% of my business is referral based. Okay, so who's my client? Obviously, you guys are my clients, right? Who else is my client? That nice, handsome young man in the back, Wally, right? So if I don't do a good job for his clients, what's going to happen? Is he going to continue to refer people to me? No. So that's why I tell people the two most important things when you're buying a house, other than getting pre-approved, is work with somebody like a Wally, right? That's very knowledgeable and is going to walk through that process with you. But you want to work with somebody that's accountable to your realtor, okay? Because there's accountability there, right? Online lenders, not that they won't. I'm not going to speak ill of any of them. Because that you might have a good experience, but they're going to be more of, it's a numbers game for them. For me, it's a client relationship for life, right? And it's a referral relationship for life. So anyway, that's a little off topic, but felt like it fit. Okay. All right, so the next slide is application document checklist. Oh, yes, sir. Capacity, income, yes. So going back to what I was saying earlier, so as lenders, people always say, well, my gross income's 100 grand, right? Well, as lenders, we know that you don't bring home 100 grand. It would be nice, right, to not have to pay any taxes, no Virginia taxes, but unfortunately that's not the case. So as lenders, because everybody has money going out for 401k and for all these other things that go out, what we use to qualify you is your gross income, but that's not what you make your payments based off of. It's your net, right? So we have this thing called a debt-to-income ratio. So we're going to take your gross income, and we're going to look at your debts, and we're going to there's going to be a ratio there or a percentage. And as long as we don't exceed 50%, then you'll find that then you'd qualify potentially. Is that kind of what you're asking?
Yes, the part.
It doesn't look like that, but I can hear you.
Another thing is, another way to put it is it depend of your, what I want to, because income is income. You have the contract with the company. They say, hey, you have
If you're
a
as an
contract
employee.
here, and look like
Okay.
I work for the company like for 1 week. I have the offer, I have the contract.
Yes. So that's a little
Do I
different.
have
You-
the capacity?
Yes, so that's a great question. So that's going a little bit deeper. When I say a person that makes a certain amount of money, I'm usually talking about a person that has a salary. You're an employee of a company, they pay you a certain amount per year, okay? Oh, can you hear me? I like to talk with my hands, so I keep doing this, sorry. I'll try and keep it right here. So income, there's different types of income that people make. There's hourly, there's commission, there's overtime, there's self-employed, right? All of those factors we have to take in consideration when we're talking about capacity, okay? The easiest is salary. Somebody pays you 100 grand to do your job, easy. You can give me an offer letter and I can use it from day one. As long as you start that job, before you close, I can use that offer letter to qualify, okay? It gets a little more complicated when you're hourly and you've worked 15 jobs over the past 2 years. That's a problem. Well, doesn't have to be, but it can be, okay? Because some job might pay you $12, another one's 15, another, a lot of people have 2 full-time jobs. Well, there's rules around, can we count both full-time jobs? Yes, but there has to be at least a 12-month period for both full-time jobs. So there's a lot more to capacity than just a salary. Commission income, overtime income, you have to have a history of receiving that income for 2 years before we can use it, okay? If somebody started last month and they're on track to make $100,000 in bonuses or commission, unfortunately we can't use it because we don't have a track record or a consistency of it yet because we haven't seen it. Does that help? Yeah, and a lot of people that are self-employed have their own companies. Those people, same thing. We have to have 2 years of tax returns before we can qualify. And it's only because, look at it from a lender standpoint. In a lot of countries around the world, they don't, for somebody to give you 100% financing or 97% financing to go buy a house and to be that partner with you along the way, that's very rare. In some countries, you got to have cash, right? We've all been to them. There's cash, right? Or you'll see houses that are built over 10 years and families come together and they start putting those cinder blocks together, and you'll see a house that takes 10 years because they're building as they have cash. We live in a great country that'll give you 100% finance, $1.2 million on a VA loan with no money down. Can you believe that? But they're a partner, and in that partnership, they have to make sure that that risk is minimal. And that's why we're talking about this here, is our job as lenders is to make sure that that partnership works. Credit shows your willingness to repay that debt, because the last thing we want is to be selling houses. Wally will say, you know, back in 2008, 9, 10, people started losing their houses, right? There's a lot of short sales, foreclosures. Banks are not in the business of selling houses. They don't want to. So they want to make sure up front that you have the capacity and you have the credit and the income to qualify. So that partnership is something that's a wonderful thing. And then, like I was talking about with a couple people, after 2 or 3 years, you have a lot of equity. And then you can continue to grow that wealth through homeownership. Okay?
Okay, I have a question.
Yes, sir.
So during his Wallace presentation, he said something about 24 months. What about if you're moving to a better job and it's paying you better? I mean, I'm talking about better income.
Mhm.
So, what does that make you? Do you have to like wait another 12 months before you start the process of getting a house?
No. And well, it depends on the type of income. So are we talking salary or are we talking hourly?
Actually, we're talking about. I mean, this is a public service. You're working with the county.
Okay. So if you're going,
So I'm talking, it's not salary, but you pay based on hourly. But I mean, it's a steady income.
right, steady. So it's hourly, right?
Hourly,
Okay.
yeah.
So that's what I was saying before. Great question. Hourly, they want to see a history. But I will tell you that people that coming from like Texas, for example, I'm just throwing it out, and they're a nurse, and they're making $25 an hour as a nurse, and they move to Northern Virginia where you make $35 an hour, okay? There is a human element to underwriting, so does it make sense? So what they would like to see is not that you just started that job at that higher amount. Even if you moved out from another state, and or you even moved from a different job that was making $15 or $25 an hour, now you're 40, that's great. But the underwriter would like to see a little bit of consistency for a little while, because you might get to that job after a month and say, ooh, this is not what I want, and jump, right? So if you're there for at least 6 months, that usually is enough for the underwriter to say, okay, we'll use that higher income and not average, because as Wally was saying with the 24-month rule, is they want to look at your hourly wages for 24 months to average if you're not salary.
So do you think it's better for you to just delay going to another job?
That depends. If you can qualify on the other job that you currently have, don't delay. Because obviously going to that better opportunity is going to give you a more income, right? But don't delay to buy. If you can buy now with that lower income, sure, do it. But I don't want to say delay the opportunity, right? Because it might be a better opportunity. And then maybe you might have to wait a little bit to be able to buy, because maybe that income that you had before didn't get you to where you want. So take the new opportunity, wait for about 6 months, ideally 12, but let's just say 6, if it makes sense, depending on the type of job. It's just when you're jumping from, and again, I'm being a little bit sarcastic here, but if you're jumping from Taco Bell to McDonald's to you working construction, to that doesn't look good to an underwriter, because there's no consistency. But if you're working a job like for the county or something that's an hourly wage, and you just moved from another industry, or not industry, but the same industry, but just a different employer, and you're taking a better opportunity, that is okay, because you're doing the same thing. Does that make sense? So again, it goes back to an underwriter's perspective, is does it make sense? And that's why they would like 6 months to show that this is something that's going to stick, instead of just being hey, it has better income, I'm going to work for a month and then go back to something else. Does that help? So it's not as, people always think that underwriting is like in the medical field. It's not black and white all the time. I mean, a lot of it is black and white, but there is some sense of gray area, and that would be a gray area. Okay. Yep. Any other questions on that? Okay. All right. So the next thing we talked about is the slide that says know your score. So I will tell you that the hurdle that probably, especially first-time homebuyers, that is the most intimidating for most is this credit score. Okay. Most people with technology, back when I started in this business, people didn't even have smartphones. Okay. So when they said credit score, you just said your willingness to repay your debt is your credit score. But really nobody knew what consists or what drives a score, okay, a good score anyway. So I know it's a little hard to read here from those that are looking at the screens, but basically you have how much you owe, type of credit, new credit accounts, length of your current history, and then your payment history. And the reason why the colors are a little different, I mean the length of those colors is bigger. That's based on the importance of those items, okay? So types of credit, that's really small, but it does, you know, whether you have, because there's only 3 things that show up on a credit report. What are they? Mortgage, installment, and revolving. That's it, okay? Unless you self-report utilities, which is very uncommon, but some people do, okay? Those are the only 3 things. People always say, well, I made a late payment on my utility bill last month. I'm in my toast. Do I not get to buy? I'm like, it's okay. It's okay. You're right. You're fine. Because it's only 3 things. Mortgage debt, which only a few people in here have. Installment debt, which is car loans, student loans, anything that's the same every month until it's paid off. That's an installment loan, right? And the revolving debt is anything other than that. Store cards, Lowe's, Home Depot, Visa, MasterCard, anything that fluctuates and you pay an interest rate based on that balance, okay? The most important thing is your payment history, as you will see here on the bottom, and then to the left, how much you owe. And that we call that in the industry credit utilization. And Wally and I have gone through this many times with clients because people overextend themselves. Okay, we all do. The more you make, the more you pay, or the more you spend sometimes, all right? And people get themselves into a downward spiral sometimes with credit card debt or with a store card or whatever. And now with the Fed continuing to raise interest rates, the average credit card percentage is probably what? I don't even know, 15 to 25%. So if you pay your minimum payments on that credit card, how quickly are you going to pay that thing off? Maybe after you're dead, okay? So how much you owe is credit utilization. If you can keep the balance on a credit card or any revolving line of credit under 30%, that's ideal. You're going to get the best score if you keep that credit utilization on all revolving accounts under 30%, all right? So when people have a $1,000 limit on their credit card, yes, technically it means you can go up to $1,000. But to get your best credit score, you're going to want to stay under 30%, okay? And then the bottom one, what we talked about, is your payment history. That goes without saying. Pay your bills on time, you're going to have a good credit score, all right? But types of credit, new credit accounts, and length of credit history, those are impactful, but not to the extent that credit utilization and payment history is, okay? So the next slide you'll see here is just the percentages, which we've already talked about based on the colors, but that's kind of an overview of how much each affects your score. All right, so what's included in a monthly mortgage payment? We'll go through this fairly quickly, but has anybody heard the term? You can go 2 slides ahead to where it says what's included in a monthly. Yep, perfect. Okay, so PITI, that's what a mortgage payment consists of, all right? What is the first P? Principal, interest, taxes, insurance. And there's one thing that's not on here that does apply if you don't put down at least 20%. And what is that? PMI, mortgage insurance, right? So people always say, well, do I have to have mortgage insurance? Yes, you do, because if you're not putting down 20%, you're going to have mortgage insurance. And the reason for that is because the lender wants protection. It's not for you. Now, in fact, you will. Maybe those that have bought homes saw something in the mail that came later and says this insurance will cover you for your mortgage. They're like, I already have mortgage insurance. Well, that's to protect the lender, not to protect you, okay? So PITI plus MI if you don't put down at least 20%. Now, if you're doing an FHA loan, you're going to have mortgage insurance no matter what because FHA requires it, okay? If you're a veteran, the nice thing about a VA loan is you have a funding fee, which is an upfront fee that you roll into your loan, but you don't have mortgage insurance. So every loan program is a little different, but the main thing is to understand that you have a note rate, right? We talked about rates being 6 to 6.5% right now. That's the principal and interest piece to this. That's going to be the same for as long as you have that loan, okay? The TI, or the taxes and insurance, that fluctuates, right? Do insurance costs go up? Yes. Do taxes go up? Unfortunately, yes. So the PI part of that equation is going to be the same forever, as long as you have that loan, if you don't refinance. The TI is going to fluctuate from year to year, okay? People always see their payment as $2,400, for example, and they see that and they're like, I can afford that. And then they call me back a year later and said, I got this thing with my escrow account that says my payment went to $2,480 now, not $2,400. P&I didn't change. That's the rate. A fixed rate, that doesn't change. It's the taxes and insurance that can go up over time. Okay, but that's not a bad thing. Like Wally was saying, if taxes are going up, guess what? Are your values going up? Usually yes, right? Now there's a little caveat to that, because back in the 2008, 9, 10, values were dropping, unfortunately, but the government still wanted their taxes. So what did they do to the tax rates? Raised them up, because they didn't want to lose their revenue, so they raised them. Okay, but the most important thing is understand that your payment consists of those 4 things, or possibly 5 things, depending on the program and the down payment. Yes. Oh.
I just wanted to ask
Mhm.
if you wouldn't mind elaborating more on mortgage insurance, because I think I might have missed. Did you say it covers the lender? Or
It does. It covers the lender.
So would you mind giving like a scenario?
So say somebody's doing an FHA loan. They're putting 3.5% down. That would require mortgage insurance, which is a 0.85% of the sales price that gets added to your monthly mortgage payment. Okay? When you have enough money from a sale of a house or your own cash that you've saved to put down 20%, you don't have to pay mortgage insurance. The lender says you're less of a risk. If you default on this loan in 6 months, guess what? We have enough equity there that we can turn around and sell it and not lose our shirts. Is that?
So let's say you're paying your mortgage
Mhm.
monthly, right? And then,
Yes.
God forbid you get laid off
Mm-hmm.
and you can't afford your mortgage. At what point does that insurance step in, or is that
That's
completely separate?
completely separate. It has that only insures the lender that if you default or if that loan gets foreclosed on, that they will still make their money back. Okay, it's not going to protect you. Unfortunately, as a borrower, your only recourse is try and work with the lender to get a loan modification, try and get a couple of payments to there's a lot of things you can do with your lender. Now, it will affect your credit, since we're talking about that, but if you truly lose your job and you're in dire straits and you own a home, the last thing the lender wants to do is foreclose on you, right? Unless, well, I'll be careful with that. They don't want to, so they're going to work with you, and they're going to allow you to modify that loan or make it so it's easier to make your payments. Worst case scenario, you go to Wally and say, the house is not worth what it was when I bought it, so you got to do a short sale. Or you say, hey, let's sell it. I can't continue to make these payments. I got to bow out, and then Wally can sell it. Does that help with the MI?
Can I add a little bit? Anyway, to avoid the PMI, the expectation is that you bring 20% down payment.
Right.
That's the only condition that you'll avoid a PMI.
Right. But if you, so people have hardships all the time. Life happens, right? So that's why I tell people when they call me and say, hey, well, you helped me buy this house 4 years ago, and now, unfortunately, I'm getting divorced, or we had cancer or something in the family, and we just can't make our payments anymore. What do I do? Then I tell them to call the servicer, work some modification out, because at the end of the day, it's a bank. They don't want real estate.
So what happens in a scenario whereby you are paying the 0.85%
Mhm.
of mortgage insurance for, let's say, like a period of 8 months, and then something happens, and let's say your salary increases significantly, and now you can afford the entire what is it, 20%?
Mm-hmm. I see what you're saying.
Then what happens to everything you've paid for 8 months?
It's protecting the lender. Yeah. So a couple things. If it's an FHA loan, your 0.85% is going to stay on that no matter what you make. And if you could have $100 million in the bank, and if you started out with an FHA loan, you still have that loan, unfortunately, you're still paying mortgage insurance. Okay. Conventional is different, though. If you get a conventional loan, then once you have all that extra income, or you can put more money down towards your loan to get the loan to value down, then you can go back to the lender and renegotiate and try and get the mortgage insurance dropped. Okay? Now, usually it automatically drops at 78%. So if you look at your original amortization schedule and you look at how much is going towards principal, how much is going towards interest, and you follow that down to 78%, that's when it automatically has to drop by law. Okay? But if you want it dropped sooner than that, after 2 years minimum, you can request to be dropped as long as you have hit the 80% loan to value. 20%, right? You got to have at least 20% equity. And that can happen two ways. It doesn't mean that you need to just put all that money in there to get there, right? Last couple of years, as Wally was saying, what, 15 to 18% appreciation? A lot of people dropped their PMI in the last couple of years because their values went up so fast that they were able to get a new appraisal, and they dropped the PMI because now they have enough equity. They didn't put 20% more into it in that time period. The market helped because of the appreciation in the values. Does that help? Okay, great question, by the way. Yep. It might take a little while for kicking. Yeah.
So it's going a little bit in the same line, but not about insurance.
Mhm.
So I have some people like, when do we refinance the mortgage, or how can I reduce my mortgage from 30 years to 15 years?
Great question as well. So it really depends on the market, and it depends on where rates are at. A lot of people over the last couple of years refinanced, right? A lot of people that had a 30-year fixed went to a 15 because their income did increase, or they looked at their rate and they could go to a 15, and even though you're paying it off much faster and the rate or the payments are usually a lot higher on a 15-year, because of the spread between the rates that they had versus the 15 years being so low, there wasn't much of a difference in payment, so they reduced it to a 15-year. It's very, very uncommon for a person to buy a house initially with a 15-year, because you're paying it off in half the time, so your payment's going to be a lot higher, which most people don't do. It's only when they refinance that they usually convert from a 30 to a 15. Now, I forgot what the other part of that question was. What was the first part of that question? When do you refinance? Oh, when do you
Yes,
refinance,
when
right?
do you
Okay.
refinance?
So the rule of thumb is you want to at least save 3/8 to 0.5% on your rate. Okay? But if you save 0.5%, say you start out at, let's just say right now you buy and you close in a month and you're at 6.5% or 6.25%, you're going to want that rate to drop at least 0.5% to refinance. Now, I will tell you that if you're borrowing 97% right out of the gate and you want to refinance if rates go down in 6 months, it's going to be a little hard to do, right? Because your value's not there yet, right? But if you have enough equity, typically you're going to want to refinance after the rates drop at least 3/8 to 0.5%. Okay, because refinance is not free. There's a cost to refinancing, okay? So, depending on the loan size, it can be anywhere, the closing cost anyway, not the escrow piece, but the closing cost could be anywhere from $4,000 to $8,000. So you have to look at that cost as well. The nice thing about a refinance, though, is that you can roll your closing costs and all the fees into your loan. It's the only time you can do it. You can't do it on a purchase, but you can take whatever those costs are, and roll it into your new mortgage balance. Did you guys have another question?
Yes, so, I have a friend of mine who refinanced her house, and the closing fee was almost about when she first started, like when she buy first. And I was like, so what do you do of that first closing fee and the second closing fee? Does it mean she lost
No.
the closing fee she did first?
No, because that was just cost of doing business, right? Taxes that you pay to the government, all that's you purchase the house, it's done. The next time you want a loan, there's going to be certain fees associated with that loan as well. Now, if those fees were as high as when they purchased, that's not a good sign. That means they paid a lot of fees and a lot of points to get what they did. See, a lot of people, when they refinance, they don't understand. And they just see a rate and they see a payment. But they don't realize that, there's costs associated with getting better rates. So I actually saw somebody last year, well, there were many people I saw, but one was in particular had, I can't remember if it was Rock, it was somebody online, right? They were paying like $20,000 in points because they kept telling me, your rate's much higher than this other lender, right? And I said, give me your fee sheet, let me look at the numbers, and then we broke it down, and our costs were like $4,000, and they were paying 20-something thousand to refinance. Their rate was better, but they were also paying a lot more, eating up equity. And that's what you have to be careful with on a refinance. It's not free. And even though you're taking that money and those costs and rolling it into that loan, that's eating up your equity. So if you started out and you owe $290 and then you refinance, now you owe $300 or $298, right? So it's not free. But the rule of thumb is every 3/8 to 0.5%, ideally you'd want to refi. Okay? Now, I will tell you, and again, this is just getting really creative here, but like, say for example, rates go down a full percent. You're going from 6.5 to 5.5. Well, maybe what we do is we go, rather than take 5.5 and pay 6,000 or 7,000 in closing costs, how about we go instead of 5.5 to 5.75 or 5.875, still better than what you have, and we as a lender will pay all of your costs. So your loan amount stays the same. I've done that a lot too, where you just reduce it to reduce your out-of-pocket or your monthly payment, but you don't have to pay any fees because we roll it into your rate by giving you maybe not the best rate, but a little bit higher rate with a lender rebate to cover those costs. Okay? Did you have?
What exactly is the correlation between interest rates now with housing and equity? Or is there no correlation at all? Or does it just... do you understand my question?
I think I do. Well, because correlation, every market's different, right? Values go up and down, right? And there's a lot of factors to that. You know, the Fed, or that they're going to ease the interest rate hikes that they've been doing. Hopefully that brings rates down. The inflation numbers, all of those things. So there is a correlation between rates and values, but I mean, I guess I'm trying to make sure I answer your question.
Like, you said you've been doing this for a long time.
Uh-huh.
In the amount of years you've been doing it, do you see that, I don't know, for example, when rates go up, does equity go up, or when rates...
No.
So there's no
There's
correlation?
no correlation.
Okay,
Now,
that's what I wanted to...
no, not necessarily correlation in that aspect, but over time, if you go back long enough, the average trend line of appreciation over time is healthy is 4% a year. Okay, now you've seen where 2008, 2009, where it went down, way down. But then if you look at the graph and you take back from like 1980 and you follow it till today, it follows a 4% trajectory. But that's why we were talking about, and Wally was talking about, there's fluctuation, right? It's not a 2-year proposition when you buy a house. You want to keep that and hold it over time. And if you do that, who cares what the values do? Like, I was just talking to somebody yesterday that bought 4 months ago, 5 months ago, and they've already seen their value drop 100 grand. Well, to most people, that's a lot, but they also bought 1.3 million, 1.2 million, something like that. So you can't look at the values. Once you buy a house and you know you can afford that payment, just try not to look at Redfin and Zillow, right? Because people always say, what's my Redfin estimate or my Zillow estimate or whatever, right? Don't look at that. It's just like nobody really wants to look at their 401k right now, right? Because they've seen it go down. The most important thing is to realize that you are doing the right thing by investing, right? If you're putting money into your 401k and you're doing it down times or up times, your dollar cost averaging, over time, it's going to go up, right? Same thing with real estate. Over time, you might buy when it's at the peak, like people did in 2006. And then it went down, and they thought they lost. A lot of people lost a lot of money. But it's all just paper. It doesn't mean anything until you sell it, right? So if you're going to have it long enough, those values came back, and now people were up 20, 30% from where they bought in 2005 and 6. So there is a correlation, but not those two things specifically. Does that make sense? Does it? Do you need more clarification?
No, it makes sense.
Because rates are going to fluctuate, values are going to fluctuate. There's different factors that cause those. Yeah.
Yeah, I have a question. So let's say I want to buy a house,
Mhm.
and thank you. And the house is like, let's say $100,000,
Mhm.
and I want to buy the house for 30 years. In 30 years, so they will just give me the price and the house and the interest for the 30 years. Right? Now let's say I will pay the mortgage maybe for the 5 for the next 5 years, and then I just want to buy the house out.
Mhm.
Am I still going to buy the interest? For
No. Great question. People have that question all the time. No, when you pay that off, it's whatever the principal balance is. So you just saved yourself hundreds of thousands of dollars in interest by paying it off quicker. Now, Wally, we use a worksheet. I have this Excel spreadsheet I put together years ago, but it actually, it'll show how much interest you're going to pay over 30 years if you just make your minimum payments. You can say, okay, this month I'm going to pay an extra 100. This month I'm going to pay an extra 400. And it'll tell you how much interest you save over that 30 years and how quickly you can pay that off. It might be 27 years, 24 years. Most people just put in a dollar amount and say, I'm going to pay $100 more a month, and then they pay it off 2 or 3 years faster, right? The rule of thumb is if you make one extra payment towards principal a year, so if your payment's $2,500, and that includes escrows, you make that one extra payment towards principal every year, you're going to shave off 5 to 7 years off your mortgage. Okay? So just because the lender says this is what, they don't want you to pay it off, believe me, because they want your interest. They're not going to say, hey, yeah, no, keep that loan. They're going to say, well, let's keep that. No, pay it off, save that interest. Because again, it's a partnership, right? You couldn't come up with $500,000 from day one. You didn't have it. So the lender came in and said, okay, based on pre-qualifying and getting pre-approved, you qualify. We're going to go into this together because you qualify. But at the end of the day, between you and me, pay that thing off. Get rid of it. Now, I'm not going to say get rid of it at the detriment of not having your savings. Like, we could go into financial planning here, talk about fully funding your 401k and Roths and all that stuff. So be careful with, I mean, Dave Ramsey. You guys know Dave Ramsey? Okay, right. He'll say, get out of debt as fast as you can, right? Which I agree with 100%. But just be careful that you're not doing one thing differently and you're leaving yourself without liquidity. Because I've been through it in 2006-07. I was making good money and the market dropped, and I was making less money and I lost a lot of liquidity. And I learned over the last 2 years when I was a lot busier to squirrel money away and to have cash. Cash is king, right? And keep your cash. So pay your mortgage off as fast as you can to save interest, but not at the cost of making sure all of your other things are in order. Make sense?
Thank you. And I have one last question. So I have a lot of friends of mine, they live in Maryland.
Mhm.
They just bought houses. And what they told me, they said whenever they bought their house, they were enrolled in a program where they were having like 1 year without paying the mortgage. I don't know if you are aware of something
No.
similar.
I don't know a bank that would lend money and say, you don't pay us for a year. Unless, I mean, there are county programs. There are, I mean, we're getting into some like Section 8 housing and there could have been where during COVID, the lenders basically said, look, you can't make your payments, and they gave people the ability to not have to make payments for a while. But I will tell you that banks are in the business of making money, okay? Even though I'm just the lender, I'm the one that facilitates it, they're going to make money. So if you're not paying for a year with most programs, or if the government says, okay, because of COVID, you lost your job, you don't have to make payments for a year. That's not free. So the interest that you didn't pay for a year, or your friends or whatever, most likely, and again, I don't want to say I know 100%, but most likely that interest they didn't pay for that year, where did it go? Got tacked onto the back of the loan. So now instead of owing $290, they owe $315, $320. Now they're upside down. Now they're in real trouble because now when they try and sell it, they're upside down. That's what happened in 2007, 8, 9, 10, where people's values dropped. They borrowed equity against their houses to buy cars, to pay off debt, and now they owed 800, or let's just say 600, and their value was 5. Okay, so I don't know for sure, but I don't know of a program, and I do Maryland loans. There are government, county programs and things for helping with down payment assistance and things like that, but the only program, it's not even a program, the only way I've seen people avoid making payments for a year is during COVID, where people got, I can't remember what it was called. It's not payment forgiveness, because it's not forgiveness. It's, what do they call that? It was something during COVID. They basically would allow people to not make their payments for a period of time, but people didn't realize when they wanted to refinance later, they would come to me and say, I want to refinance, and then they would have this forbearance. Forbearance is the word. It's been a while since I've said that. So forbearance, they had this where they didn't have to make the payments for a while, right? And so they came to me and I said, well, guess what? You have to make at least 3 payments in a row before you can refinance. And rates were going down. They were like frantic. They're like, I want to take advantage of these low rates. And I said, well, now you got to wait for 3 months because you haven't made a payment for 3 months because you were in this forbearance program. So it could be forbearance, which a lot of people, quite frankly, took advantage of, even though they didn't need to. I had a friend making $300,000 a year, took advantage of it because it was COVID, and the bank said, okay, no payments for a while. But that can affect you, right? Because there's no free lunch in this world, unfortunately. Maybe there is, but it's rare. Okay, any other questions? All right, I'm gonna end because we're over time. But the do's and don'ts, Do they have this? They're going to have this, right? Yeah, I'll provide. Okay. So the main thing with the do's and don'ts is you want to keep your credit profile the same. People are coming to me now that want to buy in July. And so I tell them basically the do's and don'ts. Don't change your credit profile. It means don't make a late payment. Don't go buy a credit or a car. Don't do anything. Don't change jobs ideally. I've had people that have changed jobs in the middle, but it better be the same or better, right? Don't go take your $100,000 job and go to an $80,000 job. Okay? The point of do's and don'ts on these slides is keep everything what it is today the way it needs when you buy. Okay? What you do after that, I could care less. You can go buy that Mercedes, that Lamborghini. I don't care. Just don't do anything during the process because that's going to affect your qualification. Okay? That's really the gist of that slide. But questions? I know we've kind of had questions throughout, but any other, that's the end of my time here. And again, I know we went a little bit deeper than probably some of these slides, but if you guys have follow-up questions, I have an app too. Does everybody have an app? Everybody must have an app. But I have an app. I have all my contact information online. If you can't find me, Wally will track me down because we work in the same office. But
I have a quick question, please.
Yes, ma'am.
So I want to ask for those who may not be making too much. I mean, income not too high, but their debt to income ratio is very low, very good. Their credit score is very high. What will stand for such a person? How much leverage do they have in asking for a loan? How much can they get?
So well, there's two factors, right? If they have a lot of income, you're saying, and their debt to income ratio is really low.
Not too much income, but their debt is very low.
If their
And
debt's
they have
low,
a
that's
very
great.
good credit score.
Right. So if I had a whiteboard here and I was talking to you guys and doing a qualification, I would say you have your front ratio, which is your housing ratio, and then you have your total debt to income ratio. Okay. Most people, I would say, rule of thumb, keep your housing payment around 30% of your gross, 25 to 30%. Okay. And then your total debt to income ratio with all your other debts up to 50. So if you don't have a lot of debt in today's world, this is different than when I started. You can actually borrow more. You don't have to keep it at 30. You'd be surprised how many people their housing ratio is 45 and their total ratio is 48. That means they're really overextending themselves on their house payment, but they just don't have a lot of debt. So you have leverage if you keep your debt low because you can borrow more on a house payment. Whether you should or shouldn't, that's up to you to decide, but the lender is going to tell you that if you make more money, right, and your debt to income's lower, you're going to qualify for more. But as I said at the beginning, just because you qualify for $1 million doesn't necessarily mean you need to spend $1 million. Because you want to be putting money into the 401k, into the Roths, into the other investment vehicles, because people come to me and say, I have this $100,000 and they want to put it in their house. What is that $100,000 worth that they put into their house 10 years from now? How much is that worth, that $100,000? $100,000. 100,000. You put $100,000 in down payment into your house today, that same 100,000, 10 years from now, still worth 100,000. It's not working for you. It's not work. Your equity is your equity. Your house is going to appreciate or depreciate, hopefully appreciate, no matter what you do. Okay? So in other words, just make sure you're comfortable with your payments and don't get overly ambitious with down payment. Okay? Because that same money, I could take that same $100,000, say, okay, I'm going to put 50 down. Yes, the payment's going to be a little higher, but I'll put that $50,000 in now, and I'm going to take this 50 and I'm going to put it over here in an investment. And if that average is 8 to 10%, that 50 grand is going to be a lot more than what this 50 is that you put in the house. So my point is just don't put more down than you have to be comfortable, and yeah, just diversify a little bit, because the whole idea of owning real estate is your money works while you sleep, right? You want your money to work while you sleep. That's the idea.
Thank you so much for sharing that.
Yep.
I have a cousin who put 200K in his house. It's 600,000 house. He put 200,000.
To me, that's no different than putting it under the mattress. But it does keep the payment down. But it's not that $100,000 working for you could do something else. So you just got to be smart.
Thanks. Yeah, thank you, Jeremy, for a lovely presentation. And we also know that there are always a lot of questions when it comes to financing. And we might have to cut this presentation short, because the latter part of this presentation is all the things that I'll be discussing with you, when we do the buyer consultation. I want you guys to be able to ask questions about your financing, and and questions about how to get to the point of buying a house. When you come to me, the first thing I normally do is, I do what I call a buyer-lender consultation, and that's with Jeremy Johnson and myself. We do that consultation with you. And in the process, we'll take you through, okay, how you can buy a house, what you need to buy a house. Then subsequently after that, once you decide that you want to buy a house, then I can follow up with you and show you how we will achieve that. The most important thing that, I always tell my clients is, are you comfortable with your payment? That is the number one thing. And we have done that. Jeremy and I have done that for several of my clients. And we say, okay, how much can you afford to pay? When you tell me how much you can afford to pay, we can tell you how much of a house you can buy. Now, if you want to buy a house that is more expensive than that, there are ways in which you can come up with additional money to be able to bring you down to that comfortable payment, So that is, I wanted to stress that, because it's, if you have money, so if you have money and you're only comfortable with a certain amount of money, you can put more money down, you can put more money down, but at the end of the day, just realize that that money that you put down there is you're just tying it down somewhere. There are so many other avenues in which you can make money in real estate. In actual fact, in the coming months, I am going to do an investment workshop here again, and I'm going to show you guys how you can make money with real estate. We talked a little bit about what you can do with your mortgages, in terms of, okay, if you pay extra a payment every month, there are a couple of things that I can show you what you can do to minimize your payment. There is also what they call a casting, right? Loan recasting. Jeremy, and that is very, very important, and we want to bring that to your attention. Let's say you inherit some money from your parents or whatever, wherever you get extra money from. You can actually take that money and go to your loan servicer, and they can use that to reduce either the terms of the loan in terms of how long it takes, or to reduce your payment. So if let's say you are struggling paying your mortgage, and you have maybe about $20,000 in somewhere, you can just go ahead to your to the person that services your loan and say, well, okay, recalculate my payment, and they will do it for a fraction of a fee or something like that. Am I right? Okay. Since we started this, about 10 after 10, and it seems like we've been here now for over 2 hours. I would like us to kind of conclude today, but I do have more materials that I prepared, And if anybody is interested, we can continue. But if anybody wants to leave, we can arrange to do that. Normally, when you decide to use me as your agent, you will get all this information. You know, I always make sure that I educate my clients, you know, so that they know what the realities of the markets are, and you know, and when they have any questions, if I don't have the answer, I'll always find the answer, you know, and that's one of the things that I have decided that I'm going to be doing, is to help my clients, even though I might not have the answers to their questions. I will go look it up for them. Now, my goal is to pay it forward. And what I mean by that is, as I help you guys to get to your next the next step of your life, I want you guys also to pay it forward. When I got here 40 years ago, nobody told me any of these things that I'm telling you now. And, you know, I thank God that I was able to acquire the knowledge. And, you know, my goal is to give back to the society. This has been a great society. You know, I've made a lot of money in real estate, and I continue to make money in real estate. Like they said, you know, like Jeremy said, when you are sleeping, you need to be making money. And that's where I want to take you guys to, is when you are sleeping, you are making money. And that's why the next step to this is buying your investment property. And, you know, I pray that God will help you guys to be able to do that. Does anybody have any question before I pass the mic over to the pastor to close this up for us? And we have a little bit of a refreshment. I think there are only a couple of you that don't have the book that I think you need it. So I have two here today, and I think I can provide each family a copy. So those of you who are members of this church, I will make sure I give it to you. I'm not going to do the raffle because, you know, there are only a few people that don't belong to this church that are here, that we can just give it to them, and then members of the church, I will make sure that I provide copies to. So, and if you didn't get a copy today, contact me and I'll arrange to get you a copy. It's a good book. I've read it myself. And if I've given it to you, please read it. Over to you, Pastor. Anybody have any other questions, lending questions or real estate questions? Because, you know, yeah, we're almost about three hours right now. Okay? Thank you. Okay, thanks.
Praise the Lord. Let us give a hand unto Jeremy and Brother Wally for that wonderful and educational presentation. Anytime I listen, I always learn something new. There's always something new to learn, because you can never know it all. And things are changing. And I really want to encourage everyone to jump on that train. When we jumped on the train the first time in 2007, we didn't know a lot. We just wanted a home period. We didn't want to keep on paying lease, which is somebody else's mortgage. But when we came on that train again in 2020, we had a lot more visibility into what we're jumping into. And this is a golden opportunity that we have in here to have them come and give us these wonderful presentations. So I'll encourage you to do it. But again, like they said, make sure you don't get $1 million home. Meanwhile, your income is only maybe 150K per year, because you're going to have heart attack. Because you sleep at night, you cannot sleep. So please, when you're making your debt to income ratio, be truthful on it. Just say the truth as it is, right? If you know you feed your home for about $200 a month, don't say you feed your home for $50, because that will push you to the other side. Just give your figures as they are, and that will help you a lot. Because once you jump into the home, it is yours. You're not going to break the lease. It is yours. You signed so many papers to get that. And it is a very wonderful thing to be a homeowner in this part of the world, because it's going to help you in many other ways, in many other things. Because the moment you put on that line that you're a homeowner, owning, not renting, you know, a lot of things come green. They appear green on your profile. So it's always a good thing to jump into it. But I always caution that don't jump from the frying pan to the fire. Make sure you're jumping and landing on a safe spot. And these two specialists here, I call them my gurus, because what they know, I don't know how they did it to know it, but they know it, and they are ready to share. I have a friend who bought a home in Maryland. When I went there, I said to myself that I could not have bought this home. Even if they were going to give me for half the price she bought it, I would not have done so. Because you don't buy a home that is dirty. You don't buy a home that the person decides not to change the carpet. Those are very minimal things to do. You don't buy a home that they refuse to change the painting. The paint has been there for God knows how long. Those are little things that you can do, but why should I do it for you if you want to sell your house to me? So just be cautious, and they will tell you that. They will. Brother Wally made us to do so much work in our townhome when we were selling it that when I go and see some homes, the way they were sold, I was almost angry with him. I said, why did you make me spend so much to put this house? But the house was so beautiful that it went on the market, went on Sunday, and we had how many contracts on Monday that we had to be choosing and rejecting some. Because anybody who entered there was like, whoa, I want to get this house. So that is some of the things that they are going to help you, walk you through. So please, if you have friends, you have families, even if they are not in this Northern Virginia area, they can still help direct them or help them out in one way or another. Like he said, his goal is not to make money from you. His goal is so that you get something good and you can pay it forward to the next person. Praise the Lord. We thank you all for coming. I know it's a Saturday. You'd have preferred maybe to go do golfing or go do something else or just sleep an extra hour, but you decided to come. I pray that the Lord who brought you here today, he will direct your steps, and that your dream home, we are going to come and do the housewarming very soon. In Jesus' name. Father, we want to thank you for this time. We bless and exalt your holy name. We give you all the glory, all the honor, and the adoration, for you are a good God. You are a great Father. We thank you for this seminar. We thank you for the knowledge that has been shared. You see, my people perish because of lack of knowledge. But Lord, we have received the knowledge this day. I pray that that which has been shared with us, we are going to put it into action, and it's going to indeed help us as individuals and as families in the name of Jesus. And I pray, Lord, that those who need this information out there, you will direct their steps even to find your sons, so that they too can be, oh Lord, partakers of this wonderful information in the name of Jesus. As we go this day, Father, I pray you will go with us. You keep each and every one of us. You watch over us. And above all, you help us. In our difficulties, in our afflictions, I pray you come through for each and every one of us in the mighty name of Jesus. I thank you for your sons, Jeremy Johnson and Wole Fasheru. I pray, Lord, you keep on blessing them. You keep on opening doors unto them, Lord. Doors that no man can shut in the name of Jesus. Whenever they will call upon your name for help, I pray you send them help speedily in the mighty name of Jesus. Thank you, Father. Blessed be your name. For in Jesus' name we have prayed. Amen. Those who are watching online, please, if you're interested in getting the material that will be shared, that was shared, please send an email to rccgbreadoflife@gmail.com and we'll get that copy for you. Just make sure you put on the subject line, First Home Seminar Presentation, and someone will forward that copy of the material to you so you can also use it. Thank you all for coming, and as I said, we have some lunch. I don't know if it's lunch or whatever meal is it at this hour, but please grab something before you go out. And we also have coffee for those who want coffee or tea. Thank you. God bless you all.